All right, folks, welcome to Leading Indicator, a show by Public.com focused on keeping you informed on the latest financial news and ideas that you need. I'm your host, J.D. Durkin. We are here, of course, to discuss Fed expectations after the FOMC's first official meeting of the year 2024. As always, don't forget to like, comment, and subscribe to our YouTube channel for more in-depth interviews to help keep your portfolio on track. Today, we are joined by Andy Constan, founder of Dampened Spring Advisors, to talk all about the current state of monetary policy. Try and help us make a bit of sense in terms of what may or may not be baked into the markets as we move forward towards potential cuts. Andy, welcome to the show. Great to have you.
Thanks, JD. It's a pleasure being here.
So we did get the decision from Chairman Powell and his colleagues last week, holding steady. No big surprise at that rate of 5.25 to 5.5. First, let me start with opening impressions, Andy, that you had when you listened to Jay Powell's either carefully prepared written remarks or, of course, the all-important question and answer we got from him last week in Washington.
Yeah, so obviously he made it very clear that he wanted to say that March cuts were unlikely. That was the clear message. But I want to step back a bit and say last week was a very busy week on lots of different things. We had the big tech earnings that were announced on Tuesday and on Thursday. We had the quarterly refunding announcement on Monday and Wednesday that showed what the Treasury was going to issue. And we ended the week with the employment number, and this all happened at a fairly interesting month end where bond prices had fallen quite a bit and equity prices had risen quite a bit, creating a fairly large sell equity buy bonds. And so during the FOMC, we got, stepping back that morning on the QRA, we got an ample amount of coupon bond issuance, which is I think of as a headwind of supply against bond rallies. And then we got the FOMC, which was fairly hawkish in that he said very specifically, let's push March off the table, or at least make it unlikely. And the markets did not get that message. They got quite the opposite message. Cuts priced into 2024 increased, and long-term bonds really rallied hard all day Wednesday into Thursday. Stocks sell-off recovered on earnings, and we had a lot of volatility last week. And then we had an employment number that was fairly hot, and bonds sold off hard.
Andy, such a storyline last year was, despite what we always say, don't fight the Fed. We know investors and the markets love to fight the Fed. Are we still fighting the Fed here in 2024?
Yeah, I mean, you have 100 after the events of last week. You now have much fewer cuts priced in. March is mostly off the table. There's a 10% chance, it's 10 to 15% chance that they still cut. So that fight has sort of died out. But the longer term fight of, what all of 2024 looks like is still fighting the SEP, which is the Fed's, best estimate of the way the economy will play out. And the other thing that was also a very clear message from the minutes in January and from Lori Logan's speech about the same time was that they're considering tapering quantitative tightening. And interestingly, Chairman Powell pushed that back a little bit, and some details around the quarterly refunding announcement also pushed back the need to rapidly taper. And the market took a while to get that message, and I think that message is still being fought a little bit with some expectations both of significant cuts still and a taper of quantitative tightening relatively imminently. And I think that's, people are still fighting the Fed in terms of what they say.
Andy, of course, I'm going to ask you about QT again in a moment, but I do want to first get your impression on what Chairman Powell had to say to Scott Pelley on 60 Minutes. Powell said the danger of moving too soon is that the job's not quite done, and the really good economic readings we've had for the last 6 months somehow turn out not to be a true indicator of where inflation ultimately is going. What were your takeaways? Did we learn anything new from Chairman Powell's sit down on 60 Minutes, especially those of us in the world that pay very close attention to what the man has to say during his public comments week to week?
Yeah, I mean, ultimately, he didn't make a lot of news. He did, push back on him being a political operative for the administration, and he did say the thing you just said. And so when I look at that, along with the other context, both in the press conference and what Governor Waller said, what they're looking for is on this Friday, they're looking to see if a fairly technical measure, which is the way seasonal adjustments are done, changes before this coming CPI. Because the path of seasonally adjusted inflation, which is the inflation number we all look at when we get the news, has been a pretty steep recent decline over the last 6 months. And it's possible all those numbers get thrown out. And the steepness of the decline in inflation actually isn't so steep. And if that were to happen, and both Powell and in the press conference really had a nervous laugh about it, because they were burned badly a year ago on this particular release. It could make the sort of progress that they've been championing look like less progress and possibly be higher for longer. At the same time, they also have begun mentioning, both in Fed speak since the FOMC and during the FOMC, about financial conditions easing, in particularly long-term bond yields having fallen significantly from their peak in November. And that says that they're being a little bit less myopic about the short rate in assessing economic conditions and recognizing that credit spreads are very tight, volatility is very low, term premiums, risk premiums are very low, and mortgage rates, that actually operate in the economy for most people have fallen a lot. And so that, along with taking March off the table, I say that they're becoming nervous about not inflation roaring back. Inflation isn't going to roar back without a supply chain disruption or a massive, which is impossible given gridlock, fiscal stimulus. So we're not going to get roaring back inflation, but they just want it to get to target. And, year over year, it's still well over 3%, 3.9% at the most reading for core. And that's a long way to home. And they're resting on the seasonally adjusted numbers declining rapidly. And if they get a bad news on Friday, I think they're going to continue to be aggressively hawkish.
So, Andy, I'd love to ask you just a quick follow-up if I can. I promise I'd ask you about QT. What part of the QT conversation are you most focused on? Of course, keeping in mind more broadly, it's still a pretty incredible economic mechanism, the likes of which I think even by Powell's own admission, we still don't really know what the total impact of the QE-QT thing is, but it is something he's talked about recently. Any quick thoughts you have before we move on there?
Yeah, I mean, the first thing is there's the money and credit available in the system that is driven by reserves and the RRP, which is the reverse repo program. There's still a lot of money sloshing around, which has the potential of creating some sort of tinderbox that could light economic activity, both real and prices, higher. We've seen very strong GDP numbers. And so they're concerned about sopping up some of that reserves. And at the same time, they're also recognizing that long-term Treasury bond yields are relatively low versus the rest of the curve and versus their term premium. And by continuing to do QT, with the Treasury issuing now at $500 billion per quarter of net coupons, it should cause long-term bond yields to rise, call it 50 basis points, and that would have a tightening impact. And so a combination of sopping up some of the liquidity and higher long-term bond yields would do the work of the Fed.
All right, let's talk about seeing exactly where some important indexes are, especially the S&P 500. A lot of headlines as of late, new all-time highs Is it your sense here, Andy, markets are expecting or pricing in what exactly with regards to monetary policy? Is it an expectation of a cut in Q2, a little later in Q3, or does it not even really matter all that much because we are in the midst of earnings and in the midst of so many other cross currents for investors to pay attention to?
Yeah, I mean, I think you just have to step back and look at the stock market. I've been a macro investor for, I don't know, half my career and a single stock investor for all of my career. And when I look at what's happening in the S&P 500, in the NASDAQ, and in the Russell, to me, it's very clear what's happening. Six stocks are dominating the returns. And so if you go back even 12 months ago when when Microsoft bought ChatGPT or made its investment in ChatGPT, over 100% of the returns of the equity market of the S&P 500, the biggest representative index, has been six stocks. Tesla just dropped off to making no impact, but over 100% is Mag 6. And if you break that down even further, and this is in particularly the last couple of weeks, of the total return of the S&P, which is around 27% over that 12-month period, 42% is just NVIDIA. So the contribution of NVIDIA to the total return, when you market weight it based on its market cap, et cetera, is almost half of the total return of the S&P 500. So if you're going to try to play macro and try to understand what's happening in the macro environment, you're really getting an S&P 500 that is really unchanged, with NVIDIA driving half the performance of what did happen. And I have no opinion on NVIDIA. It's obviously a great company and is right in the sweet spot of the picks and shovels of AI. But when you look at macro, I would say that the S&P 500 is not pricing in significant improvement in economic conditions, though the earnings of the S&P 500 are pricing in about 11% year-over-year growth. And so even the stocks that are not the Mag 7 have fairly optimistic growth outlooks. And so I look at the equity market ex NVIDIA as being ex these big stocks as being a little rich. And I don't have an opinion on these big stocks. They seem fully priced and quite aggressively being chased. But that could go on for another year or another month. We just don't know.
All right, fair enough. All right, let's talk a bit more about big tech. Just some of these names, Andy, you and I were just talking about. Some positive momentum as earnings season, of course, has continued. We talked about Meta up more north of 15% or so in the last 5 days. Amazon up more than 7%. We talked about NVIDIA's incredible performance already year to date and over the last 52 plus weeks or so. Is the market rally focused, you think, on the macro trajectory, or more so based on, still a lot of kind of hopium and hype surrounding these big tech AI plays? And does the lack of broadening out kind of concern you, that we're not necessarily seeing so many of the small caps join in on the fun?
Well, I mean, I think that from a macro standpoint, what's interesting if you look at big tech, and I put this out on Twitter a few days ago, big tech's currently generating sales at 6% of the total GDP of the nation. And that's up from 3% 5 years ago. What's interesting is with all of this extreme performance by these stocks, over the last 2 years, if you include Apple, which has seen sales declines, if you include Google, which has seen sales declines, all of these companies are actually not increasing their sales along with GDP. So I think there's a lot of expectations built into these stocks, but so far the money isn't coming down to the bottom line. And so that's the question, and when I think about macro and I think about a GDP as being all of the companies, all companies in the United States, what they make and sell, including individuals, small businesses, et cetera, the conditions for GDP growth are okay. The economy's pretty strong. But what has to happen for some of these companies to grow as rapidly as they're priced to grow is either the GDP pie has to grow a lot, which it's not, or the GDP pie has to be eaten by these big guys. And so I think some of what's happening in the broader market is that CEOs at companies that are not big tech are now saying to their group, we need to be in AI, and they're budgeting large purchases for their engineering teams to incorporate tech into their stack, AI tech into their stack. And from what I've heard, and this always happens, when you have the CEO pushing stuff, you often have some digestion problems with the team who doesn't see the value in AI yet. Whether they're trying to protect their job or they're trying to really be, valid engineers and figure out if this is a useful tool or not. There's some rejection of that I'm noticing. And so the question is, how far will the CEOs who don't have a lot of resources, because their stocks haven't been doing that well, their earnings haven't been doing great, but they know that they have to keep up with the guy next door that's investing in AI. And how long will they push that, and what will it do to earnings? So I think it's possible that we continue to have, and my call for the year is that Mag 7 will continue to outperform the broader market because of those frictions that are occurring. Like the AI investment is strong. Whether it's going to Microsoft for cloud or for NVIDIA for chips, that buying is happening. And it's enriching those companies that are doing the selling. And the companies that are doing the buying may take some time before they see any improvement in revenue or profits. And that can cause their earnings to decline relative to the big seven. So we'll see how that plays out. But the macro conditions, to me, don't support equity prices at these levels and don't support bond prices at these levels. But hype in NVIDIA can, as I said, was 42% of the year's return so far, the 12-month return. That can drive the markets farther.
Well, I think it's very obvious. It obviously was the biggest story of 2023 and certainly shaping up so far as of early February to be the largest, if not one of the biggest stories here for 2024 as well. Thank you for the perspective and context, says Andy Constan, founder of Dampened Spring Advisors. Andy, thanks. Look forward to continuing the conversation later on in the year as these stories shake out. Thanks a lot.
All right, JD. Thanks for having me.